Well, good morning. I'm Mark O'Hare from Preqin, and we're here on a glorious sunny morning in Geneva at Super Return Emerging Markets. And I have the great pleasure to be talking with Peter Schmid, the head of private equity at Actis. Peter, good morning.
Good morning.
Peter, just to touch on it first, last week was quite a momentous week with the clear signals coming from the Fed and also from the Bank of China. So the end of quantitative easing is nigh. A lot of volatility. Is that a fundamental change for emerging markets, or just part of the ongoing volatility that you guys live with every day and every month?
Well, we see this, in the 20 years I've been investing in emerging markets, we've seen this volatility in the currency and the flow of capital back and forth. I think that in many ways that almost opens opportunity, because the fundamental fact is that we look at across our portfolios, and it doesn't matter where, which parts of the regions, whether it's in Brazil, South America, all the way through to Singapore. Our companies continue to grow at 20% compound in dollar terms, and that's just a fundamental, tailwind that's just coming from the emerging consumer across these markets.
That's a good point. So in a shift to a lower return environment, you really have to find alpha, and therefore hence emerging markets. Now, what's going on in emerging markets? Is it same as it ever was, or are there fundamental changes going on in what you see in the market?
I have to say that I think we are now going through a phase which is causing a fundamental shift in the way GPs are having to tackle some of the problems. And the biggest issue, I think, that you'll know is around exits. People inability to exit companies. I mean, you just look at China, where we've done over 10,000 deals. I think only a quarter of them have been exited to date. And part of the problem has been that a lot of people have done lots of minority deals and relied on IPOs to exit. And that, of course, has not happened. India is the same story.
Right.
And I think that it's no different to what we saw in the developed world and I saw in South Africa in sort of a decade ago, where we started off doing minority deals, very little influence. And as prices moved up, as competition got keener, you've suddenly had to adapt your model, and it's now GPs, no different to what you would in Europe and the US, have to add value. You have to have control, or at least have significant influence in your deals, and you have to be able to really get in and be an active investor in terms of what you do to create value, because pricing and the overhang of capital in a lot of our markets, some of the bigger brick as means that relying on buying low, selling high, those days are gone.
So that sounds like a fundamentally tougher market. As you say, you have to add value, so presumably that has implications for, can you fly in and find opportunities, or do you have to be on the ground? Talk to us about that, Peter.
Well, I think for us, and I think every GP is different, depends on their skill sets and the regions and sectors they cover. But I think, again, number one, certainly in emerging markets, you have to be on the ground. That is a fundamental risk mitigant, I think, and also to be able to tap into what's really going on. And most important, to be able to access managers. The biggest shortage and the main reason of where we've got into trouble in the past has been about backing the wrong manager, or not having access to the top actual managers, operating managers in businesses. And I think, therefore, having a sector-focused approach is absolutely key in what you do. But just as important is having operating partners on the ground who can actually, who have got the capability to really intervene with their local managers, so you've got to be aligned and really create value, whether it's on the sales line, whether it's the margin line, whether it's the supply chain. That is absolutely key going forward.
But just to recap, Peter, I mean, despite the fact that, as you say, the opportunity for, if you like, low-hanging fruit through buying low and selling high has kind of gone, do you still believe there are good opportunities for private equity firms and investors like yourselves to add value and create good returns in emerging markets?
Well, just to give you a sense, I mean, in Actis we've done over 110 deals. We've exited close to 80 of them now. And what we see is continuing, the fundamental underpin of why would an LP invest in emerging markets is very simple: growth.
Yeah.
I mean, if I go back over the last decade in our portfolio companies, one of the things we track is what has been the growth in our operating profits in our portfolio, just on an aggregate basis. That has ranged consistently, irrespective of what's happened in the various markets, between 18 and 22% compound in dollar terms. So already, without even starting, your IRR from the investor, you're getting the 20% growth, provided you're picking the right subsectors and the right quality businesses and managers. But that's not enough to attract, I think, or it's not the kind of returns that GPs or LPs will want, particularly in a more volatile region like the emerging markets.
Yep.
So where do you get the other 10% from? Historically, we've made I'd say the other 6% came from multiple arbitrage, buying low, selling high,
right.
and 4% from yields, because very little comes from leverage in our markets. I think that next 10% is the key part. To get your gross 30% RR, the 20% will come from the growth if you do the right sector selection, but the 10% I think is going to be the ability to get the buy low, sell high is gone.
It's gone.
You have to substitute that with actually creating value in the value in the businesses. And I think there's also an increasing opportunity as the debt markets mature to use leverage to really enhance your returns. And we're seeing that more and more in our deals. So that gives you an idea. But emerging markets, private equity returns, I'm still very bullish that's going to outperform.
Great. Now, Peter, emerging markets covers a multitude of different, I won't say sins, but opportunities. Tell us some of the areas where you're seeing exciting opportunities today. Just, not all of them, but just a couple of areas, themes, trends that you find very exciting for creating value.
One of the things that I find fascinating is how fast our markets change. So, and I almost feel like it's speeding up. So when we raised our third series of funds, India was very, very popular, and we were heavily oversubscribed. In those days we had cycles. We actually decided this time to just move to a pure global fund, because we believe having total flexibility to be able to move and find value depending on where it appears, even over a 5-year investment period in a fund. And I think that's very much borne out by experiences. And so I think
and Peter, does that correspond with what LPs want? Do they want a global exposure, or are they not saying, I want Latin America, I want India?
And I think that's where LPs bifurcate, because some are very much wanting to select the best country manager, and yet the others who have gone through an experience of finding high turnover in local funds,
and they want your expertise,
and they want someone who's on the ground, who's actually experienced enough to know where to allocate capital. So I think our product, for example, suits some LPs, others it won't. But I think for us, the most important thing, that drives us and has got to be, is about generating top quartile returns for investors. Because one of the things that is currently, we can see it playing out, is, does an LP stay in the US mid-market buyout fund where he knows he can get a specific return, or is he prepared to venture out and go into the emerging markets, but then he wants to know that it is consistent long-term returns and you're not going to lose money? Because I think the days of doing 10x in a lot of our markets and some of the deals, despite the fact that we lost some money, those days are gone. I think if you lose money in some of your portfolios now, you're going to get into trouble in terms of your net returns.
Peter, thank you very much indeed. Pleasure talking. Thank you.